Stocks surge, sentiment lifts, but the bond market is whispering something darker. Relief rallies rise fast, and fragile foundations can crack even faster. Right now, markets are moving on hope, not proof. The headlines just lit up. The United States and Iran have agreed to a peace deal aimed at ending nearly 4 months of conflict, and investors moved instantly. Stocks rallied. Oil tumbled more than 4%, with crude sliding back toward the low 80s. The dollar softened. For a moment, it feels like months of tension are finally melting into calm, but underneath that celebration, something quieter and more cautious is still unfolding. Because while stocks are throwing a party, bonds barely showed up. And that hesitation is the most important signal in the market right now. Here is the clean, comforting story you're being sold. A deal means less risk of supply disruption. Less disruption means lower oil. Lower oil means cooler inflation. Cooler inflation means the Federal Reserve can finally ease off. And if the Fed eases, stocks have every reason to run. Logical, tidy, case closed. But that is only half the picture, and the other half is hiding in the bond market. My name is May, and this is Rules Changes, where we read the signals underneath the headlines, not just the headlines themselves. Today, I want to show you what bonds are seeing that stocks are choosing to ignore. Let's start with oil, because oil is the hinge this entire rally turns on. Oil isn't just another commodity, it's the bloodstream of the global economy. When it rises, transport, manufacturing, and shipping all get more expensive, and inflation builds across nearly every sector. When it falls, the pressure releases, costs ease, margins improve, and central banks get breathing room. That's why even the hint of an Iran deal is so powerful. Iran is a major producer. Ease the tension, ease the sanctions, and you strip out the risk premium traders had baked into every barrel. Oil drops, and the market's mood flips with it. So equities did what equities do. They saw lower oil, imagined cooler inflation, assumed a friendlier Fed, and rallied. But now, here is where it gets serious. This entire chain reaction is built on expectation, not confirmation. There is no finalized agreement yet. What actually exists is a draft memorandum, a framework on paper. The Strait of Hormuz, oil sanctions, an end to hostilities, all of it is proposed, not sealed. The situation is still fluid, fragile, and fast-moving, and markets, as we've watched again and again, can reverse just as fast as they rise. And this is the part almost everyone is missing. The bond market is not buying the clean story. When the deal news hit, the 10-year Treasury yield barely flinched, slipping just a few basis points to around 4.4%. Think about that. If bonds truly believed inflation was about to roll over and the Fed was about to cut, yields would be falling hard and pricing in those cuts. They're not. The 10-year is sitting near its highest levels in months. The short end of the curve is holding firm, and some Federal Reserve officials are still openly floating the idea of raising rates, not cutting them. That is the tension. Equities are celebrating an all clear. Bonds are refusing to sound one. Why does this divergence matter so much? Because stocks and bonds are driven by different things. Equities run on optimism, momentum, and short-term narrative. Bonds run on cold, long-term reality, inflation expectations, interest rates, and the structural health of the system. When the two move together, the signal is strong. When they split apart like this, it's a warning. And right now, that gap is widening. Now let me connect it to the bigger picture because bonds aren't just looking at oil, they're looking at everything behind it. Even if oil stays lower for a while, the structural inflation problem hasn't gone anywhere. The most recent reading had US inflation running at 4.2%, the hottest in 3 years. The US national debt is approaching $39 trillion, with interest payments alone now crossing $1 trillion a year. Deficits keep climbing, and the Fed is still walking a razor's edge between crushing inflation and breaking the economy. A cheaper barrel of oil is temporary relief. It does not fix any of that. And the bond market knows it. Bonds are looking at the debt, the deficits, and long-term inflation and quietly asking one question. Is this rally actually sustainable, or is it just another hopeful headline? Now picture what happens if the deal falls apart, and drafts fall apart all the time. Oil could spike again, fast. Inflation expectations would jump. The Fed would be forced to stay restrictive or tighten further. And the very stocks rallying today could reverse just as quickly as they climbed. This is not a stable foundation, it's a fragile framework. And in fragile environments, the assets that behave differently become the most important ones to understand. Which brings us to gold and silver. Normally, during a geopolitical relief rally, you'd expect precious metals to pull back as fear fades and risk appetite returns. But watch closely, because something unusual happened this time. Even as the deal news broke and fear drained out of the market, gold didn't fall. It actually rose. Analysts flagged it as the outlier of the whole move, and outliers tend to be telling you something. Here's why. Gold isn't only reacting to today's headline, it's responding to the deeper structure, real interest rates, currency stability, and systemic risk. If bonds stay cautious, if inflation stays sticky, and if the Fed stays trapped between two impossible goals, the case for gold doesn't weaken on a peace deal, it quietly strengthens. Silver adds another layer, because it carries both monetary and industrial demand. It reacts to financial stress and to economic activity, which makes it more volatile, but also more revealing about where growth and inflation are really headed. So while equities celebrate a possible breakthrough, the metals are watching the bigger, messier picture. And that picture is anything but resolved. This isn't a world where the risks got fixed. It's a world where the risks got temporarily repriced. And that distinction is everything. When markets move on hope instead of hard outcomes, volatility doesn't vanish. It just pauses. Think about the pattern of the last few years. Over and over, markets have rallied on a hopeful headline: inflation about to cool, the Fed about to pivot, tensions about to ease, and over, reality has come back to test those best-case bets. So the real question is whether this moment is genuinely different or just the next turn of the same wheel, because if the bond market is right, this isn't the end of the volatility, it's just the next phase of it. And that's exactly when positioning matters most. Not chasing stocks higher on momentum, but understanding the balance between risk and resilience. Not reacting to the headline, but reading the signal underneath it. That's why gold and silver keep earning a place in this conversation. They don't depend on corporate earnings. They aren't tied to any single country's policy. They sit outside the traditional system, acting like insurance against instability. They won't move in a straight line. They'll wobble, they'll react to sentiment, but over time they track the deeper currents driving the global economy. And right now, those currents are anything but calm. So as stocks rally and the headlines turn hopeful, the question worth sitting with is this: what is the bond market seeing that the stock market is ignoring? And more importantly, what happens if it turns out to be right? I want to hear from you. Do you think this rally has real staying power, or is it another short-term move built on fragile optimism? Tell me in the comments. I read every single one, and your perspective shapes the videos I make next. If you want to go deeper into these shifts, where geopolitics, markets, and monetary policy actually connect, join the Rules Changes email list. The link is right below this video. And if this kind of analysis is valuable to you, you can support the channel by buying me a coffee. Every contribution keeps the research going. This is May, Rules Changes. Keep reading the signals underneath the headlines.